Welcome back to the Dividend Diplomats YouTube channel. You've got Bert and Lanny here, and we're ready to bring you a nice, fun dividend stock analysis across the major credit and debit card processing companies. And we're talking Visa, Mastercard, American Express, and Discover Financial Services.
So everyone, smash that subscribe button, give us that thumbs up, ring that bell so you can get all the notifications every time we release a new video, because trust us, we are bringing you new videos multiple times every single week, and you do not want to miss out on any of them.
You do not want to miss me bash Bert every single other day.
Yeah, don't worry, the comebacks, I'm waiting for the right moment to strike.
Yeah, Bert's in that, the comebacks are going to be better than the setback.
Yeah.
As a lot of these companies are dealing with through the case of the pandemic.
Hey-o. No, I'm kidding.
But, as we said earlier, we're going to talk to you about 4 dividend growth stocks in the credit card and debit card processing industry. We all see them on our cards, in your emails, on the commercials. Heck, if you're not getting something in the mail about one of these cards, then you most either don't exist.
Yeah, it's funny. It's every day. It's sign up for this. You're pre-approved for this level. Get 30,000 points. Get 5% cash back in this category. Yeah, the offers are plentiful. People want you to spend and use their card so they can rack up some of those fees and interest income on some of your loan.
Yeah, and on top of that, there's the interchange income that financial institutions and merchants are trying to battle between. So the credit card companies are strong dividend growth stocks.
Yep.
They have been for the better part of 8 to 12 years. And that's why we really wanted to talk to you, investors that are just starting, or current dividend investors, as well as, dividend investors that are looking for other stocks to buy or acquire to add to their dividend portfolio.
Mm-hmm. Yep, and we picked these 4 because these are the 4 major players, as Lanny mentioned earlier. So if you want a card in the credit card industry, these are the 4 you're going to be looking at. I know Buffett owns some of them as well. Lanny owns some of them. Buffett and Lanny are the one and the same, so I think we're...
Yeah, Warren, Lanny, Lanny, Buffett, it's interchangeable at this point.
Yeah.
But, when you actually think about the cards in your wallet, usually it's your bank that's providing you a card, and then they get to choose what type of card that they want, whether that's a Visa, Mastercard, American Express card. Then obviously Discover really has their own type of card. So when you think about Visa and Mastercard, they don't really have your account on their books.
Yeah.
But American Express and Discover, that's what makes them a little bit different, is that they actually have your account on their books, or can have their account on your books.
Yeah, exactly. So if you look at the financial statements for each one of them, if you want to, after this video, look at the balance sheet, you'll see a nice line item on the balance sheet called loans receivable for Discover and American Express. That is missing from Visa, so it's a huge... And you'll see when we're running it through the stock screener in a little bit, you're going to notice that's why some of the metrics are slightly different between the two. You'll see Visa and Mastercard in one coupling, Discover and American Express in the other.
And what better way as a new investor, a current investor, or even an advanced investor, to have one of these companies in your portfolio, because in the digital world and in the pretty much money as a currency world, it's not really being used. So really you need that digital / card payment. And what better way to have a great stock in your portfolio than a card company that pretty much is going to be used in everybody's everyday life.
Yep, I love it, and that's why we've been adding to them over the year. Over the years, Lanny was one of the original investors in this, and I'm starting to slowly build a position in them as well.
Right, so now we're going to take you through the Dividend Diplomat stock screener across all 4 credit card, debit card type of processing companies, and that again includes Visa, Mastercard, American Express, and Discover. And Bert, what are the 3 metrics in the Dividend Diplomat stock screener?
All right, let's roll through them. Number 1, price to earnings ratio is less than the S&P 500. Metric number 2, your dividend payout ratio is less than 60%. And metric number 3, we have the dividend growth history, and we review the dividend growth rate for each of the companies.
And we may also throw in a bonus metric here by looking at the dividend yield across all 4 card companies. And again, we're going to pin these companies toe to toe to see if there's a potential dividend stock to buy now for yours and even our portfolio.
Yep, so let's kick it off. Let's jump right in. The coffee's ready, coffee's flowing. Let's do it.
Yeah, I mean, if you guys don't have your Dividend Diplomat mug while watching this video, shoot us a message and we'll see what we can do.
Yeah, it may require you using your Visa, Mastercard, or one of your cards to buy one, but...
Wow, touche.
All right, so metric number one.
So let's go into price to earnings, and we'll start it off with Visa.
Visa, dun-dun-dun-dun-dun-dun-dun. No, I'm kidding. So Visa's price to earnings ratio is 33.62% using the current prices today. So obviously I mentioned metric number one is less than the S&P 500. The S&P 500 usually trades at a PE ratio between 18 to 20. So Visa at 33.62 is significantly higher than the current market.
Right. I mean, that's very high. Currently trading at close to $200 per share, and analysts are projecting, almost $6. It's just a very high, earnings multiple on their share price, which going into the second company, Mastercard, you're going to see pretty much the same story, as their price to earnings ratio is just a hair under 38.
Wow. Man, so it's even higher than Visa.
Even higher than Visa. But let's go into the third company, American Express. What do their price to earnings look like?
Their price to earnings ratio is 14.69%. So wow, that is much lower. If anything, that's obviously below the market. They're showing signs of undervaluation.
And below the competition.
Oh yeah, very much so below the competition. So let's just bring in the fourth entrant into this to see where the last and final one, Discover, shows. Lanny, what's Discover's PE ratio?
Discover Financial Services. They're actually below 9. Our calculation shows, based on forward earnings, 8.91 for their price to earnings ratio.
Man, so I think this right here is a perfect visualization for what we were trying to describe before. You have your two companies that make their money off of their interchange fees and don't hold the loans on their books in Visa and Mastercard. And then you have the two that do hold loans, American Express and Discover. So they kind of have some of the bank valuation metrics in there as well, which is why it is significantly lower than the other two.
So we just went through the price to earnings ratio across all four. You have Visa and Mastercard, the two, big dogs in the card processing industry, trading at over 30 and some even close to 40 on the price to earnings multiple. Then you've got the other two, which, again, holds loans on their books at below 15, and even with Discover below 10. I'm not sure who the clear winner is here, but...
I mean, I think we see the two that are leading the race right now. In my mind, you with AmEx and Discover at least showing the signs of undervaluation.
It's time to jump into Dividend Diplomat stock metric number 2, the dividend payout ratio.
All right, Visa, with their dividend payout ratio, we are calculating a 20.55% dividend payout ratio, which is significantly below the 60% threshold that we use in our dividend stock screener. Typically, we even have our dividend sweet spot of 40% to 60%. It's half of that, the low end of that metric.
Right, so they're obviously still in that high growth phase. So instead of paying out more to their shareholders, they're keeping and maintaining those earnings to continue to grow their business.
Yep. Let's see if Mastercard's the same story. Lanny, what's Mastercard's payout ratio?
Very similar story, and actually it's a even better story, I guess, from a lower payout ratio standpoint. Just when we thought we couldn't get any lower than the Visa, they're actually calculating to be about 18.5% on the dividend payout ratio.
Wow. So they had the higher PE ratio in the last one, the lower payout ratio in this one. Interesting. Interesting seeing these two compared against one another.
What about AmEx, Bert? Time to roll into AXP.
Yeah. All right. AmEx's payout ratio is 25.48%. So a nice little bump compared to Visa and Mastercard. And Discover, let's round it out. You're going to see a huge jump here in the dividend payout ratio. It's 45.71%.
So similar to the last round, where American Express and Discover had lower price to earnings multiples, you saw higher dividend payout ratios amongst these two companies of AXP and DFS, or American Express and Discover. More than likely because the card base is just different, as well as their balance sheet. Now, Visa and Mastercard being the two giants, they're continually in a high growth phase from number of cards, revenue, et cetera, et cetera. So naturally, their payout ratio is going to be lower. But it seems like right now, I kind of like American Express.
Yep, I agree. I'm excited to see how the rest of this screening and comparison is going to play out.
Now, what I will say, though, none of the payout ratios scare me personally because they're all below the 60% threshold and show that they can continue to currently pay that dividend as well as more than likely continue to grow that dividend, which is a great segue into stock metric number 3, the dividend growth.
So Visa, their dividend growth rate is 20.14%, a very high metric, and that's awesome in today's current environment. They've been increasing their dividend for 11 consecutive years.
Right, so they're already building up that history of strong dividend growth, and them having double digits, let alone 20%, far out, is going to outpace their increase in their net income year after year, which is why you still see a low dividend payout ratio in the earlier metric.
Yeah, Lanny, what was your cool little fact you were telling me before we shot this video?
I have owned Visa stock for every single dividend increase that they have had. I'm not that old, but this was one of my very first stocks I bought back in the day. Now my back's giving out, but that Visa card is, keeping my wallet straight. So
yeah, you've owned this long before we even knew each other.
Yeah, before I even knew this, Don. I'm kidding. Bert loves talking about the dividend growth because he wishes it continues to give him a growth spurt as well.
Hey, I've said it from my 20s. I'm going to have my growth spurt in my 20s. It's coming in my 30s now. I know it, but hopefully I'm not topping out at a nice 5'7" here.
Talking about Mastercard now, the second giant here, they have actually kept up with Visa. Their dividend growth rate, again, over 5-year average is over 21%. Again, how would you like to have your dividend income grow year after year by 20+%? Well, so far Visa and Mastercard have allowed investors and all investors alike have that opportunity, and they've consistently increased their dividend for 8 consecutive years.
Yeah, so let's look at AmEx now. American Express dividend growth rates aren't as high. We're calculating a dividend growth rate of 9.96%. So obviously it comes down, similar to what the split we've been talking and we've been seeing looking through the first 2 metrics. So overall, I'm not that surprised. A 10% growth rate is still pretty strong. Laney, I'll throw the exact same question. How would you like your dividend income to grow by 10% every year?
I know personally there's got to be a lot of people watching this video that would take any increase right now, especially as dividend cuts have been pretty prevalent during the global pandemic, as well as at your current employer.
Yep.
I can almost guarantee that 5 out of 10, if not more, aren't even receiving pay raises this year. So, how about a 10% increase to your income?
Yeah, and similarly, American Express has increased their dividend for 8 years as well, which is right in line with MasterCard, a little bit behind Visa, but I think you're going to see a nice trend here in the credit card industry in terms of dividend growth history.
Bringing it back here with Discover Financial Services on their dividend growth, the 5-year average is actually over 11%, surprisingly.
Oh, yeah, interesting.
But you have to keep in mind that their payout ratio is also a little bit higher now. And I know they have a lot of student loan programs, and they've caught a little bit more heat recently with the loans on their books, with recording additional provision for loan losses and having to reserve for potential problematic loans on their books. Yeah. So not to say that 11% may not be the rate going forward, but that's at least the rate over the last 5. And they've increased their dividend for 9 consecutive years.
Yeah, I think it's a very important point. This one is probably the one where the growth rate will come down for the reasons Lanny mentioned, especially if we do continue heading towards a recession or something happens in the future. For a company that holds a lot of consumer debt on their books, you can see where that may end up and why your earnings may decrease in the future.
Right. Now it's time for the dividend bonus stock metric, the dividend yield.
Yeah, Lanny, you want to start it off? What's Visa's yield?
Well, before we go into Visa's yield, the S&P 500 dividend yield is somewhere in that 1.8 to 2.2%. Just depending on what you like to actually look at and consider the S&P 500 dividend yield. But Visa, man, it's not that high. It's actually only 61 basis points, or in the other words, 0.61%.
Man, that is a very low dividend
So
yield.
take it like this: for every $100 that you invest in, you get a whopping 61 cents.
Yeah, what's interesting to see with the yield at that level coupled with their high dividend growth rate. It's just interesting to see how those two metrics are going hand in hand, because you can then put two and two together that their earnings are growing like crazy as well.
And if you thought Visa is low, it can get even lower, baby.
Yeah. Mastercard's dividend yield is 0.49%.
Man, just when you thought that the Hogan leg drop couldn't get any harder.
Yeah, we have the sweet chin music coming in.
Yeah, at 0.49%, again, you definitely can earn more in your savings account. But however, I would say Visa and Mastercard are extremely long-term games here, where if it continues to grow, again, as Bert said, in a 20 to 30% rate, that yield on cost will actually pick up over time.
Yep. So now we're going to see a little bit more yield here as we transition into American Express and Discover. American Express's dividend yield is 1.73%, so just a hair under the broader market, and definitely a lot higher than the Visa and Mastercard dividend yields.
Right. And then Discover Financial, this is, they've had a significant impact to their stock price over the last 4.5, 5 months, and their dividend yield is actually now over 3.4%, so much higher than the S&P 500. You could say it's twice as high as American Express, and obviously far superior right now to the Visa and Mastercard dividend yield.
Yeah, no, this is great. So I think now that we've run each one of these companies through the dividend stock screener, let's think about this for a second and figure out which companies we're going to watch, if any, and which ones we may be buying in the next few weeks as well.
Right. Now, I know it's obviously a very personal finance decision to think about what stocks you want to add to your stock watch list, or what stocks you want to buy during the month at your brokerage account, to increase your dividend portfolio and dividend income. There's really probably no real clear path to a winner here, but we'll give our own judgment, obviously full disclaimer, on what I think and what Bert thinks his favorite stock is on the credit card processing companies.
Yeah, so right now, just from my opinion, on my own looking through this, Visa and Mastercard are trading at an extreme premium compared to the broader market. Their dividend yields are significantly lower than the stock market. So right now, these are fantastic companies. Don't get me wrong, I'm saying that. I'm just not watching them, and I'm not going to be buying them over the next few months.
And it's similar to like your Apple stock, as well as your other high growth stocks out there that actually pay a dividend. Not saying that they're bad companies, but just saying right now the fundamental dividend metrics just don't make sense.
Yeah, however, I gotta say I'm a little intrigued by American Express as we continue to go through this. I like how they offer a yield in line with the market. Yeah, they have a slightly lower dividend growth rate, but I also I'll have to take a deeper look into their lending portfolio, see who some of these average metrics are for the people they're lending to, and if it's strong consumer debt, I'll maybe considering adding this to my watch list going forward. Same with Discover as well. Although again, I'll have to evaluate a little bit more risk that comes with their portfolio. So Lanny, what do you think?
Taking all current positions aside, I would have to agree that American Express AXP actually has a lot of positive signs here. It's not an unusually low PE like Discover. It's kind of right there in a nice little 14 to 15 price to earnings mark. You can argue that the dividend yield is right there with the S&P. But the caveat is that the dividend growth, you probably have a good sense that it's going to be at least 10% plus going forward, and I'm fairly confident in that being the case. And they have a significantly low dividend payout ratio that's in line with Visa and MasterCard, except you're getting an exceptionally higher yield. So honestly, that's one stock that I'm going to strongly consider to buy.
Yeah, I think that's a great takeaway from this analysis. So, and all of you as well, please let us know your thoughts on the credit card industry. What companies are you watching, if any, from here in the comments section, and why you may be watching that particular stock?
We'll leave, obviously, all our reference material below in terms of how we evaluate, where we evaluate the Dividend Diplomat Stock Screener, the 3 critical metrics. And we're obviously very curious on what you think is the best company out of these 4 stocks that we just talked about today.
Yep. So again, also, if you like this page and you like this analysis, please subscribe and give this video a thumbs up. We're going to keep pumping the content again. So just keep getting ready. So the thumbs up will help us let us know that you like this content and you want to see more videos like this.
And if there's a company that we didn't consider in these card companies that you'd like us to look at or that you want to mention, please do that below. This is Bert and Laney from the Dividend Diplomats.
Over and out.